Hello, property navigators. As of August 2025, median dwelling values in Brisbane are up 7.9% over the past year, around 76% in the last 5 years and 93% across the decade, meaning the average property bought just 10 years ago has almost doubled. Now, most of that uplift has landed in just the last 3 or 4 years, when Brisbane's house values rocketed, outpacing nearly every other capital. Is it still worth buying into? Today, we'll unpack the market performance data region by region, present the demand engines versus the supply choke points, and map the outlook and opportunities through to 2046. Let's go! First things first, so many times here on YouTube, we see that these three labels are used interchangeably, but they're very different things. Brisbane City is a local government area, or LGA, governed by Brisbane City Council. It's Australia's largest council by population and covers a huge footprint of urban, suburban and semi-rural areas covering over 1,300 square kilometres. The Brisbane River winds through the middle, effectively splitting north and south, with suburbs fanning out roughly 20 to 30 kilometres from the CBD in most directions. The next step up is called Greater Brisbane, a region that the ABS says covers over 13,000 square kilometres, so it's about 10 times bigger than Brisbane City LGA. Now, it includes 5 neighbouring LGAs, all within close proximity to one another. They are the cities of Brisbane, Moreton Bay, Ipswich, Logan and the Redlands. Greater Brisbane is your metro market where most property price, population, rental and listings data get reported at a capital city level. We often see Brisbane and Greater Brisbane labels getting used interchangeably, but they are very different things, so don't get tripped up on that. The next step up from Greater Brisbane is Southeast Queensland, which takes in 12 LGAs, including the 5 from Greater Brisbane, plus the Gold Coast, Sunshine Coast, Noosa, Somerset, Scenic Rim, Lockie Valley and Toowoomba City. This is the broader planning region defined by the Queensland Government and is used for the long-range pipeline of infrastructure and land release that dictates where future stock and price pressure will actually show up. Such forecasting is covered in the state's Shaping Southeast Queensland Regional Plan, the playbook for where population, jobs, transport and housing will end up being placed between now and 2046. We will be referencing the data within this document quite a lot today, while discussing the 3 regions that we just outlined in their correct context. Before COVID, Greater Brisbane had affordability that Sydney and Melbourne just couldn't match. Large blocks, a maturing CBD, a great fringe job base, and a lifestyle proposition that was starting to click with people nationally. We were on the ground buying property in Greater Brisbane and Southeast Queensland well before COVID, and we had front row seats watching the domino effect of factors the pandemic kicked off that turbocharged demand. It's been astonishing, so I'll briefly run you through it. Firstly, migration. Year after year, Greater Brisbane dominated internal migration. People flooded into the region from all other states, and it really didn't stop. Then, as international borders reopened, students and visa holders returned. The population absolutely skyrocketed. Brisbane Times reports that as of mid-2025, over half the state's population is now living in Greater Brisbane. And from 2025-26 onward, for the first time since 1978, Greater Brisbane will officially have more residents than the state's regions combined. It's a massive growth story in a very short time frame. As a result, property prices pushed higher as those record numbers of people moving to the region bought homes. Queensland residents also took advantage of low interest rates and bought their first homes. Then there were also investors jumping into the growing market. Now, this squeezed the region's housing supply, creating an extremely limited stock environment, not only in sales stock, but also in rental markets. As the population grew, demand totally outpaced supply. Rental stock reduced as all those people moving into the region bought properties to live in, and if they didn't buy, then they needed to rent somewhere themselves. So vacancy rates compressed across Greater Brisbane to historically low levels. At the lowest point in 2022, vacancy was sitting around 0.6 to 0.7%, and even though it has come up as of August 2025, we are still at just 1%. A 3% vacancy rate means a market is somewhat balanced. So a 1% vacancy rate or below means virtually virtually all rental listings are snapped up immediately. Now, due to this scarcity, rent prices soared in each of Greater Brisbane's LGAs. Demand held very strongly relative to available supply. New listings bounced around but sat and still do sit well below long-run norms. Many property owners sat tight knowing that if they sold, it would be difficult to find another property, and if they did, they'll be paying higher prices the market was now demanding. You can see here across the LGAs of Logan, Moreton Bay, Redlands and Ipswich that supply fell off a cliff. When we overlay pricing data, we can see that while supply fell, prices pushed upwards at an astonishing rate. This can also be clearly seen in Brisbane's LGA across the northern, eastern, southern and western quadrants of the city. In unison to severely limited supply, building approvals absolutely fell off a cliff and developers struggled to bring enough new house and land or off-the-plan stock to market, so pipelines thinned. That imbalance is what kept price pressure soaring even as interest rates climbed. So there's a snapshot on the Greater Brisbane market over the past 4 or 5 years, albeit in a nutshell. The question we get asked most by clients every day is, can the market keep going in this trajectory? To explain this, let's start with the fundamentals. Firstly, population. Southeast Queensland's population is expected to gain about 2.2 million more residents, or 1,600 people per week by 2046, reaching around 6 million, up from 3.8 million today. This growth is roughly a 1.8% annual increase, which would make the region comparable to the size of Sydney today, bringing in around 1 million extra jobs. We can see Brisbane City is slated to absorb the lion's share of that influx, increasing by over 460,000 people. But it's not all about having the highest physical numbers, because that represents about a 36.5% increase. If we look at Ipswich, it is gaining around 246,000 people, but that's a 105% increase. Logan is expecting around 316,000 people, equaling a 90% increase. Moreton Bay is plus 63% with 308,000 newbies, and as always, Redlands City, being the smallest, is trailing with almost 50,000 new residents, equaling plus 30%. Housing targets versus the supply challenge. To accommodate this growing population, the state government has set ambitious targets averaging 34,500 new dwellings per year, adding up to 900,000 new homes by 2046. By drilling down further into the individual LGAs, we can see that Brisbane City alone will need over 210,000 new dwellings. Ipswich is more than doubling its dwelling stock. Logan is not quite doubling, but close. Moreton Bay is increasing by 2/3, and the Redlands is increasing stock by just under 1/3. But achieving these targets is looking pretty sketchy, as current data shows that construction is lagging well behind what's required. In Queensland, seasonally adjusted data shows only about 3,427 dwellings were approved in July 2025, whereas roughly 4,100 per month is needed for Queensland to contribute its fair share of the National Housing Accord's target. In fact, by early 2025, Queensland was 29% behind its cumulative housing completion target. The Real Estate Institute of Queensland has also highlighted this gap in the construction pipeline as an acute housing supply shortage, and this is a structural problem here in Queensland. The REIQ points out that Queensland's stubbornly tight rental conditions are systematic of years of underinvestment in housing supply, compounded by rapid population growth, and stresses that there's absolutely no silver bullet other than building more housing as quickly as possible. This means that in the short to medium term, supply is relatively inelastic. It's not responding quickly enough to the surge in demand, so the imbalance will persist. The supply-demand imbalance is evident in the number of on-market listings available. As of August 2025, Brisbane alone had roughly 16,106 properties listed for sale, which is dramatically below the long-term average of 28 to 30,000 listings for this time of year. In other words, the number of properties available to buy is just over half that of historic levels. This tight stock situation continues to create more competition for each property, placing upward pressure on prices. This supply challenge is the crux of Brisbane's market trajectory. If supply remains constrained, prices and rents will likely keep climbing. Whereas if supply somehow catches up, it could gradually balance the market. But at present, all signs point to a persistent undersupply, which is a key factor in where the market is heading. Strategy to increase supply. The Queensland Government and Greater Brisbane LGA councils are responding with strategies to encourage infill development and smarter growth rather than simply opening new greenfield suburbs. Greater Brisbane, for the most part, has been considered low density, with big blocks and big yards, but it's been slowly changing, and big changes are coming in the future. The government has set a goal of moving towards a 70-30 split in dwelling growth, 70% infill within established areas versus 30% expansion on the urban fringe. This is a shift from the previous 60-40 infield to greenfield ratio, reflecting a tighter focus on building up, not just out. Now, this split essentially means more townhouses, apartments and units, higher density housing around transport centres and corridors, job hubs and in areas where infrastructure already exists or is planned. So as an investor, it very much matters not just where you buy, as in your LGA selection, but at a micro level, being very specific with which suburbs and asset class. Make sure you note this, because a lot of buyers agents in Greater Brisbane are pitching the idea of simply buying a house on a big block and adding a granny flat, talking up the idea of high yields. Now, that's short-term thinking. This market is transitioning and fast, and there's so much more to understand to attain a property's true investment potential in the long term, which we'll drill into now. In the planning, there's four main dwelling types. Firstly, there's detached dwellings, which means a house on its own block of land. But in the future, they'll be on much smaller blocks to be able to fit more dwellings into the same area. So a future subdivide strategy needs to be considered for house purchases being made now. But be careful, because heritage-listed buildings can't really be touched, and Brisbane City in particular has a lot of them. Then we have the attached class in three different categories. Low-rise, which includes dwellings such as row or terrace housing, townhouses, low-rise apartments, units, duplexes, triplexes, and even quadruplexes. Then there is medium-rise apartments and units. Lastly, there's high-rise apartments and units. Now, each category increases the density of people that can live in the given area of land. Of the new property types getting built through to 2046 in southeast Queensland, just 40% is houses, with 60% being made up of low, medium, and high-rise developments. In practice, this means the region is moving from houses being 69% of total stock to 58%. Low-rise will pivot from 22% to 25%, medium-rise 4% to 6%, and high-rise boosting from 5% to 11%. So some big implications here that need to be taken into consideration. We need to drill further down into each LGA's individual dwelling targets, because each have different forecasted population growth and therefore different density requirements. For example, Brisbane City is replacing 14% of its houses in place of 6% more high-rises and 4% more of both low and medium-rise developments. This means that if you are investing now for development potential later, exactly where you buy matters. You need to think of things like future zoning and the block-specific attributes required by council for this. On the other side of the coin, Ipswich will lose 10% of its houses, and both Moreton Bay and Logan will lose 14%. But there's hardly any high-rise development activity slated in these regions. Houses will predominantly be replaced with low-rises. So again, this should be strategically reflected in the property and block attributes you are looking for now. In the long term, well-located areas around new and upgraded transport nodes will be poised for higher development potential and could see significant uplifts in housing value as we see older homes on large blocks gradually replaced by low, medium and high-rise developments. Now, in terms of demographics, it makes a lot of sense that there's growing demand for higher density, smaller dwellings. More than half of Brisbane's households are now singles or couples with no children who don't need a traditional 3 or 4 bedroom house. Yet only about 1/3 of housing stock is 1 or 2 bedroom dwellings. The aging population is also driving demand for downsizing. Affordability. Greater Brisbane's market dynamics are being reshaped as buyer budgets aren't stretching as easily to buy a house as they did just 3 or 4 years ago. As a result, lower price segments of the market have seen the strongest demand, and data shows entry-level properties in Greater Brisbane are transacting faster than premium homes as buyers compete for the limited stock of affordable dwellings. Units have been recording faster price growth than houses, a reverse of our usual trend, because they offer a cheaper entry point. Over the year to August 2025, Brisbane unit values jumped about 11.1%, with a 3.9% gain in just the last quarter, whereas house values rose around 7.3% in the same 12-month period. Looking ahead, the consensus among most analysts is that Greater Brisbane's property market has robust fundamentals that will support continued growth, albeit at a more moderate pace than the recent boom. Domain's latest forecasts project that Brisbane's house prices will rise about 5% over 2025-26, which would take the median house value to roughly $1.09 million by mid-2026, which is a new record high. Unit prices are also similarly forecasted to increase at 5% to around $701,000, which is also another record high. This represents healthy growth, but not an outrageous boom. Essentially, a continuation of the upward trend, but at a slightly slower and much more sustainable rate. Affordability constraints will likely put a ceiling on how fast prices can climb year on year, meaning the boom-like growth we've seen is behind us. Consider that in Brisbane, the mortgage repayment of a median house now eats up 50% of a typical dual-income household's earnings, up from just 28% in 2019. Households simply can't stretch budgets indefinitely, so price growth is expected to gradually align more closely with income growth. For Brisbane, this might mean mid-single-digit annual growth in property values. The wild card, once again, is supply. If the government and the private sector manage to dramatically boost housing construction, then the supply-demand gap could start to close. That could ease pressure on prices and rents somewhat. The state government is certainly aware of the issue and is pulling policy levers, but these solutions take time, and in the short to medium term, 1 to 5 years, it's widely expected that supply will remain tight relative to continued demand. From an investment perspective, the outlook for Brisbane property remains positive. In practical terms, investors can expect that well-located properties in Greater Brisbane will attract continued buyer and tenant demand. Lastly, I want to note that Brisbane has officially crossed the $200 billion mark, with the 2025 State of the City report confirming the city's economy hit $201 billion in 2024, up $28 billion or 16% since 2020. This comes from population growth, the city adding 274,000 jobs, a record $13.7 billion in visitor spend, and an infrastructure pipeline exceeding $100 billion. Now, looking forward, the report says Brisbane's economy is on track to reach $275 billion by 2041. This includes a forecast 10-year expansion across property and construction of plus 41%, transport and logistics of plus 43%, advanced manufacturing of plus 29%, and a 50% increase in the knowledge economy. Now, all of this shows sustained long-term economic prosperity. Before we wrap up, today's video is all about the fundamentals, so I purposely haven't focused on the 2032 Brisbane Olympics. Now, we have 2 videos that specifically lay out the billions in infrastructure spend and the corresponding property growth in relation to the Olympics that some analysts are predicting. You should check them out as they are eye-opening, and the link is just down in the description. The Olympics are obviously a driver of Brisbane's economic outlook and a massive play in the attraction of the city, and in a way can be overlaid on the fundamentals we have spoken about today. Nonetheless, Greater Brisbane's property market is headed into a period of sustained growth, underpinned by durable demand fundamentals rather than boom-like conditions we've seen recently. But remain mindful of where new supply is coming from. And remember, as always, real estate is local. The meso and micro factors like choosing the right LGA and suburb are essential. You or your buyer's agent need to be across the specifics so you get the most out of your investment. If you aren't being presented solid data that's backed up by deep research and zoning knowledge, and are simply having LGAs or suburbs shot at you without evidence, you need to get a second opinion. The Greater Brisbane market has changed. Gone are the days of making big gains without the smarts behind selecting the right markets and assets at exactly the right time with the right attributes for future profitability. And we can help you with that. Just give us a call or visit our website and book a free chat with Boyd and I. Until next time, happy property navigating.